So we're in section 11 of chapter 1 of your business book, and we got to the example that's on page 87. And so the example looks like, okay, what are they going to make us do here? But just take one thing at a time, and then we can find out how we're going to write everything in our journal. Here's going to be an example of our journal, and that way we can keep accounting. This is how you keep accounting. Don't let it get complicated. You just take one thing at a time. So example 2. So I wrote all of these things in a different way. So it looked like a big paragraph. You had to write each thing out. So I, first of all, wrote everything out. So this is your example. So if you can read my writing here, I kind of wrote it quickly here. You put at the top, printing. So you're going to put at the top, you're going to know this is going to be top printing. It had several financial transactions, and you can read it there. So first of all, they bought a new printing equipment on June 13th. They bought new printing equipment at $17,893, and they paid cash. Then on June 14th, they paid their payroll, salaries and wages, which came to $15,360. Then on June 17th, they borrowed $215,750 from First City Bank. So then on June 20, they had a wedding invitation. They actually printed a wedding invitation and got $1,049 of cash. Then on June 21st, they basically a business law firm. They brought in $2,192, charged their account for business law firm printing. And so then on to June 25th, they borrowed $45,000 for damage from a bank. So they had $45,000 worth of damage. Where do they have that? Let's see. It says, since Tip Top did not have cash in to repair the damage, so wait, what damage do they have? Then while the construction workers were building, a bad rainstorm hit and flooded the whole site, causing $45,000 worth of damage. So since Tip Top did not have the cash on hand to repair the damage, they borrowed it from the bank on the 25th. So they borrowed on the bank $45,000 for the damage, right? $45,000 for the damage, yep. So the next thing, after the damage, we have when Tip Top compiled their income statement for their business year ending May 31st, the result was a net loss. They had a loss of $22,000, and $22,193 was their loss. And this amount was subtracted from their capital, and on the 30th of June, hoping that this situation would never occur again and they could make enough money to overcome that situation. So they were in the loss. This whole thing, they're in the loss. So I just went over one thing, each thing on each date, down to June 30th. So now I have all the dates kind of written here. So I'm going to put it somehow in a ledger. So every entry debit has a credit. So this is just what we were doing. So $17,893 was increased in equipment. So if it's increased in equipment, it's going to be a debit, because what asset, remember, increase is going to be in debit. So this is going to be a debit. And then their cash, since they took the cash out, the cash went down, it's going to be opposite from the debit, so it's going to be a credit. Okay? So I wrote that for number 1. So the next thing, paying the employees with cash. So they paid $15,360. So that went up in their expenses. So their expenses went up. So if you do expenses there, it's going to be in the debit. Okay, because expenses right here went up. Salary and wage decrease in cash. So you're going to decrease the cash though, because you had to pay him. So the asset would go down, and so this would be a credit. So here you have a balancing going. See how these balancing out in each one? They have a debit and a credit, just like we did before. Borrowing money, they borrowed money, so $215,000 increased in cash, because now they have all that cash. But so if you increase in cash, would increase your cash, would be an asset, it'd be a debit. Right? And that's a debit. So $215,000 increase in liabilities, though, because it's in accounts payable. So it's increase in liabilities, which is click. Increase in liabilities would be a credit. So it's credit. See how I'm doing this? So the wedding invitations, they're going to be increase our cash. So if they're increasing our cash, asset, they're increasing our cash, it's going to be a debit. So they're going to have increase in debit. Income, though you're bringing in income because you're printing fees, you know, so income is click income. So you increase your income, it's going to be a credit. Business forms, accounts receivable assets, you know, so you have these business forms, increase your accounts receivable. And so accounts receivable means you're going to have more money in your asset. So you're going to have more money in asset is going to be a debit. And so then $2,000 in printing income. Usually asset and income are going to be, you know, the opposite. So you have income, click, income's right here. It's going to increase your credit. So increase the credit. Borrowing money to repay $45,000, increased your expenses. So increase your expenses, asset, right? Expenses is going to be a debit. So increase your liabilities, click, increase your liabilities is going to be a credit. Credit. So paying with cash, increased rent expenses is going to be, it was $3,280, and this is going to be increasing your rent expenses, increase your expenses, asset, increase your expenses would be debit. Decrease in cash assets though, so your cash is going to be decreased. So if your decrease is going to be opposite the debit, it's going to be credit. See? Losing money, they lost a bunch of money, right? Losing $22,000 capital, basically equity capital. So you're not talking about capital now. So you're looking at click capital. You're going to decrease your capital. So it's going to be opposite from a credit. It's going to be a debit because you're decreasing your capital. And then $21,000 decrease your cash. So here's your cash. Your asset and cash is going to decrease. And so it's decrease. What did I say? That's going to be a credit because you're decreasing it. See? Okay, each one of those we went over. See how we did that? Okay, after you do all of that, then you have to put it in a ledger, in a journal. Here's our journal. Okay. So the first thing we had here, let's see. We had $17,893 increase in assets, and then we had there's a decrease in cash. One's a debit and one's a credit. So all of this we have to record here. So this is what we're going to record. So we put our equipment and our cash. So in our equipment, we put down our debit of $17,893, and then we had purchased printing equipment for cash. So in our cash, we put as a credit $17,893. So just like I said here, equipment, we put in the debit, and we put the cash in there, and they balance out. Bing, bing, bing. So we're done with that one. And that's happened on June 13th. Okay, and June 14th was the salary and the wages. And so, first of all, we had salary. Trying to get this so we understand. So we had the salary. We had an increase in salary and wages, which gave us a debit. And then we had a decrease in cash, which gave us credit. So we have the salary and wage expense increased, so we have $153.60, and then the cash again decreased, so it was opposite when it turns to a credit, when it's opposite. There we go. So we have these two, debit and credit. And then we put down salaries and wages paid for the first 2 weeks of June. We put down anything we need to know about it, so when we go back, we can see, oh, that's for salaries. So the next we have borrowing money. We borrowed $215,000 in cash. As we borrowed that money, that's a liability. We in cash, increased our cash first. So our cash was increased. So if our cash was increased, it'd be in the debit. So we have two, because our assets were increased, and be debit, $215,000 cash payable. And we made a loan, that would be our liabilities. So our liabilities were increased. You know, if we have liabilities, of course, we have click. Liabilities means credit. So we put it in the credit. So these two balance out. One was for our cash, and one was for the liabilities. Now on to the cash and printing income. So the printing fees. Remember the printing fees? Okay, this was for the wedding, right? Printing fees. And so basically our cash was increased. So our cash was increased. If our cash was increased, cash increased our asset, we had debit. So we put down debit, cash increased. And then the printing was the income. The income was increased. Income was increased, would be credit. So here we have, again, balancing out. Let's finish it up. So we have, the next was the business forms, from the lawyer's business forms, right, that we printed. Accounts receivable, we received money, which would be our asset, right, because cash. Accounts receivable printing fees would be the cash. Well, actually, accounts receivable fees, so they're not in cash yet, but they haven't paid it yet, but they're still our asset. So the asset would be debit, so it's written as a debit, $21.93. Printing services rendered on account, so printing fees, so that's going to be a fee, would be, again, that would be our expenses. So expenses is E, and so that increased is going to be, or that printing services rendered on the account would be printed services rendered. Printing fees would actually be opposite than would be credit. So sorry. Business fee, accounts receivable would be a debit, because it's on accounts receivable, it would be a debit. And then in the printing, it would be income. I'm sorry, I said asset, income. So this would be income. The income would be $21.95, which would be a credit. So, and then we write down what they did. Repairs. Okay, what happens with repairs? They had to borrow money. Repairs, accounts payable now. So they had to do the repairs money. So expenses. So this would be expenses on repairs. Asset would be expenses. That would be on the debit. That's right, for $45,000. And then they had to make a loan, so that would be liabilities. Click liabilities. So liabilities would be a credit. So these two are opposite. So they balance out. So now on rent expense. Okay, the rent expense. Rent expense, we have expenses. Expensive. So the rent expense increased, so it's going to be a debit. So it's written on the debit. And cash is paid for June. Cash, so the cash went down. Our asset of cash went down, so it's opposite, so it'll be on the credit. 3280 and 3280. So owners, equity. So this is capital. So the owner's equity. So if we have click, capital went down. Capital went down, $22,193. So that's going to be the opposite of credit. It's going to be debit. And then our cash asset. Our cash went down. 2, and so then it's going to be opposite. As a debit, it's going to be a credit. So bingo, bingo. See how they balance out? This is how you do a ledger. we're going to get to the account numbers, but make sure you put down, this is the date, will be October, this going through the month of October, and then to put down each one, debit and credit, and then put down any due to annual net loss or something, do any notes you need to put after between them in each one. So those are daily journals. Okay. What am I doing here? Okay, this daily journal you're supposed to do, and this is what we did. This is on page, this is on 11A that we did. Remember we did that, we already did and went through each one. They just want us to record it all. So let's look at that. I can remember. Right here. So it says, office supplies. Remember we put down that it was going to be, basically office supplies was going to be debit or credit. So expenses or liabilities, you know, so we put those things down. So, so office supplies, and it was a charge an account of $138. So office supplies is going to be, because it's a, because it's an expense, or office supplies, I mean an asset actually. So we have an asset, so office supplies accounts payable is going to be, an asset would be $138. So, and then we took off, it says expenses and liability. So we had to buy it on credit. So if we put down click, basically liability on credit, so it'd be the credit. So we have 138 accounts payable. Office supplies accounts payable 138. So we still have to pay it. We haven't paid it yet. That's our credit on credit. And our office supplies we have at 138. They balance out. The next one here, we have utilities. Utilities are expenses, increases our expenses, right? So if we increased our expenses, so let's do, just do asset increased our expenses, it's going to be a debit. So we put on debit. So this is utilities, cash, right? Expenses, you put it on our debit. Utility expense paid in cash. So we paid it, so our asset of cash goes down. And so that means it's going to be opposite the debit and be credit. So we put those here, paid in cash, opposite there. On to the next one. This was the total sales, or $54,362 received in cash. So our cash is an asset cash. Our cash is going up, so it's going to be debit. So we have debit here, $453.62 in the debit. And the income from the sales, the income is click, right? Income. So income is going to be our credit. So the cash, although, and the income, they balance each other out. So this is the capital loss of equipment. So let's see what we say. Number 4, 11,500. Loss of 43,960 in capital income. So this has to do with capital. So income decreases as capital, and assets increase. So capital, of course, is going to decrease. So click decreases. So if it decreases, it's going to be opposite of credit. It's going to be debit. So we have 43,000. That's going to be our debit. Equipment sold to pay for the debt. So the equipment sold to pay for the debt is going to be our liability. So click is our liability. So that's going to be on the credit side. Raw materials. Let's see. Raw materials. Did I get down here? So get down here too low. There we go. Did you get capital? 43,000. See how they write it too? Make sure you write it right in here, and then put this for no dollars or cents. You know, put a dash. Loss of equipment. This is raw materials. So let's see. This is number 5. $11,500 charge on account for raw materials to make vacuum. That's cost. That's going to be our cost. So it's going to be our cost goes in asset cost, right? And so the raw materials cost increases, so it's going to be on the debit. So 11,400. The materials for vacuums charged on account, that's our liabilities. So that charge on account, liability is going to be on our credit. So rent, $813 some dollars rent. So first of all, our rent is expense. So we say asset expense, and the rent is expense. And so as the expense goes up, it's going to be on our debit. So it's 8,315. And then we took it out of our cash. The cash went down. So that's on credit because the cash went down. So 83.15. So accounts payable on number 7, $21,000 in materials not needed sent back to suppliers, or to reduce the cost to produce vacuums. So basically cost of goods went down. So the cost of goods went down. If the cost of goods went down, let's say cost of goods, it's asset went down. It's going to be opposite. Cost of goods, accounts payable to raw materials. Actually, the cost of goods went up. Sorry. So it's going to be 21,000. And then the liabilities. The liability, of course, click liabilities. You're going to owe it, so it went up. So it's $21,000 on the credit. Materials returned to supplier. Office supplies cash. Okay. So it says office furniture purchased with cash. So this is pretty easy because you have asset. So purchased with the cash, you had to pay the cash, so the cash is going to go down. So that's going to be on the credit. And then the office supplies purchased. First of all, they're purchased, so you have a liability. So that's going to be a debit, $54.32. And then the cash is going to be cash. Paid is almost always going to be credit. Just say that. So cash on owner's equity. So number 9 says $10,000 cash contributed to the business capital. So we have capital, which is click there, and it increases. So we're going to have our credit. Our credit is going to be our contribution. So it's $10,000. And then the cash in itself increased. So if cash increased, we got more money. That cash increase is going to be debit. So we have 100,000. See how I do this? So we have accounts payable. So anyway, each one of these, see how they balance out. Bingo, 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 all the way balance, all the way out. And you just do each one separately to see how they balance out all the way to the bottom here. So as you can see, accounts payable, is going to be our accounts payable. So that would be liabilities. And liabilities, we paid some of it, so it's going to go opposite. So it's going to be a debit. And then the cash paid to supplier. Our cash is going to be paid to supplier. Going down is going to be our credit. See how each one? Cash sales, let's see what number 11 was. Received $1,000 from client for services. So we have income, we have expense and income. So cash sales would be the debit, because we're getting more cash. So assets increase. And so if it increases, it's going to be debit. Cash paid for income. Click income. So income goes up, so it's going to be credit. See how those two things. Labor, paid $500 worth of labor. That's going to be expenses, right? So expenses goes up. It's going to be a debit. So it's on the debit side. And then cash for labor in the sign. And the cash paid for labor in the sign with the cost is going to go down. And so that's going to be on the credit. Notes payable on cash. Last one paid, anyway, notes payable on cash, 7,500. So you have acid. So notes payable and click. Okay, notes payable will be liabilities. So liabilities are paid, so liabilities are going to go down, so they'd be on the debit. So it goes 75 on the debit. Cash paid on the loan, so we had to take that cash out and pay. That goes down, so it's going to be a credit. Okay, so figure each one. Okay, there's a bunch of exercises here. So I'm going to go over, let me see if I can go over a couple of the exercises here, see if you can see how to do them. I don't think you need to do them all. Best Buy grocery store pays their 13 bags. Let's see if I wrote these down. I don't know if I did here. So anyway, you see how this Best Buy pays their bag boys $5.85 for their 15 grocery clerks and $9 for their butchers. And I think I did do that equation someplace. First of all, you have to figure all that out. There we go. Best Buy grocery. We'll just do this one. So 13 bags for 13 bag boys are paid $5.85 an hour, $5.85 an hour. And the grocery clerks, the butchers, and the bakers, and you put them all then in their 40-hour work week, and you're paying for 2 weeks. I did a lot of calculation on this here. It looks like, so as their wages. So basically here we do times 13. So 15 groceries guys there, 2 butchers, and 10 or 3 bakers. So got all their money there, right? So you added all that money up here. Here I added them all up. Here, and I got this much money. But that's how much money for an hour. So now they work 80 hours a week, or 80 hours for 2 weeks, because you're talking about 2-week period. So I had to times this by 80. And so I got $22,064. So whether I did it this way or this way, $22,064. So there's $22,064 in expenses. So, okay. Where do we put that? The hardest part was figuring out how much all that money was. So the wages in cash. So the cash is going to be what? Acid, cash. So you're paying it, so the cash is going to go down on your assets. And so that's going to be a credit here. That'd be the credit. But the wages and the expenses is going to go up. So the expense is going to go up, so it'll be debit. So there we got debit in the wages. And then the cash that you're paying out is going to be your credit. So they balance out. So this part actually is the easy part. The other hard part is figuring out all of this part. So Bob's Real Estate. Bob's Real Estate, Jerry's office. These are 3 different places. And together, so we have Bob's Real Estate together. They had to pay all of this. So you add up the utilities. So I had to add up the utilities and then divide it by 3. So they're going to pay $469.18 utilities, $1,000 in rent, and also $156 in utilities. And I had to divide all those by 3 in different sections because they wanted them differently. So divided by 3. Okay. And so I got utilities because they wanted utilities or rent. So the utilities were $156. So 39 cents, that's what I got too. And that was, we're going to pay in expenses. asset expenses. So I paid it in expenses, so it's going to be a debit. That's our expenses. And then the cash, our cash went down. Our cash, this went up and our cash went down. So asset to cash. And so it's going to be opposite from debit, be credit. So see how these two? So rent, so that we divided the rent was, we had to divide them up between the three. That was kind of tricky. So anyway, so the rent is going to be our expenses again. Our expenses went up. So that was going to be our debit right there. Rent, paid with a rent with cash. The cash, of course, is going to be an asset, and that asset is going to go down. I'm sorry, because we used it. So see how they balance out. Okay. Smitty's dog houses. I did a lot of work on this one. 3 sheets of plywood and a half a gallon of paint. I forgot to, you have to half that, that's a trick right there. Half a gallon. That means you have to half that. And then they built 127 dog houses. So how much do they need? Expenses, plywood and paint right here. That much plywood and paint. Then you have to times it by 127 dog houses right here. So you got $6,294.12. So raw materials, you need your raw materials, your expenses. Expenses would be asset, expenses would be here, expenses would go up. So it's going to be your debit right there. And then charged on account would be liabilities. Liabilities right here would go, your liabilities would go up, so it would be a credit. So it's on credit. Okay. All right, I'm going to stop here. We're getting kind of going on and on. Let's see. I did all of these too. Each one, you need to find, each thing, and then you basically want to put the debit and credit for each thing that's going on. Debit and credit, debit and credit, debit and credit. So you're going to be doing all those. So I'm going to stop now, and then we're going to get into the ledger, and then I'm going to do a review, and then we'll do the test.